Welcome to Nasdaq TradeTalks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio in Times Square, New York City, we have Phil Mackintosh, chief economist at Nasdaq, as well as Chris Dearborn, managing director on Nasdaq's Market Intelligence Desk, and we have Matt Markiewicz, and we are all here to discuss what's happening in the macro space. AXS Investments, it is great to have you back, Matt. From a macro perspective, it seems as if a lot of this has shifted towards what we're looking at in the labor markets as of recently when we focus on the data.
Yeah, and there are obviously a lot of data points that the Fed is looking at, outside of inflation. It's just going to create a lot more volatility heading into the end of the year.
Yeah, and it certainly is, Chris, and we're starting to see pockets as well. I mean, on the Markets Intelligence Desk, you are talking to NASDAQ-listed companies in the consumer space, and they have been seeing some stress with the consumer.
Since the Fed had pivoted from inflation to labor and the other part of the mandate, the focus has been, for the most part, on what are they going to do to stabilize what's going on. You had a number of data points. You had the BLS out today with jolts and came in much lighter than expected. The markets really didn't react to it. But you have non-farm payrolls coming out on Friday, and you get continuing and claims on Thursday and then the following week as well. So new claims and continuing claims are kind of the key. They're forward-looking when you're looking at the data here. And the question is, with GDP data from last week, is that the U.S. economy is consumer-driven. It is really almost, two-thirds part of sales. And when you look at that, the question is, can the consumer keep spending to pull this market out? And that's where we've kind of been. The labor market is the key here. Wages have grown, but they haven't been keeping as much with inflation. Inflation's come down, but rates, even though we're telegraphing a 100% cut in September, we have to wait to see if it's a basis point, and a quarter point or a half a basis point really is going to make much of a difference. It's a telegraphing that they're going to have into that. Right. And the question that comes to, can the market sustain that? Because the consumer names have really been hit hard across the board. Yeah. You have the haves and the have-nots, today even the dollar stores that came out today and some of the others are getting hit, making new 52-week lows because the lower incomes are not spending and people aren't trading down for that spend.
Right.
It's going to services, it's going to leisure, and you're not seeing a lot of consumer names really doing well. However, there are some of the larger stores across the U.S. that are doing very, very well. Yeah. A couple that are not listed here.
You're seeing that shift into a Walmart as an example.
You do. So we'll talk Walmart and Target. They're doing very, very well, but they're also broad-based in what they're selling, right? They're not specific. They're eating some of the other smaller companies' lunches, and with that, those companies are really starting to suffer, and that the consumer is trading down the value. And if the labor market continues to crack here, that's going to be a problem for consumer spend. As consumer spend, again, is the key to pulling this country out of where we are heading at the moment.
So, Phil, and I feel like that's what the concern is, because we were focused on inflation, right? Or even perhaps the housing market and why we're looking for these rate cuts and so forth. But now that we're talking more about the labor situation and we're seeing those types of revisions, it feels as if it could get a little bit real.
It feels like it could get real, but is the labor market really cracking? When you look at the data, the increase in the unemployment rate is because of people coming in and trying to get new jobs rather than people getting let go. Right. So the impact on spending because of that's really different. If you lose your job, you were spending and suddenly you stop. If you think you might try and get a new job, then nothing really changes until you get that job and then you start spending. So actually this is a little bit different than a normal uptick in the unemployment rate, which is why even the SARM rule converts are sort of talking about maybe we need to wait to see layoffs start to pick up, which to your point, I mean, there's small cap stocks do seem to be hurting. The interest income or the interest expense on them is definitely going up as a percentage of their earnings, crumping their margins, and they look a lot less likely to hire people. But the large cap space, still hiring, still doing really well.
Yeah, and Matt, when you think about it from an investing perspective, what are your thoughts in terms of volatility as we head into a more seasonal, volatile time of year? And of course, the national election, of course, there's going to be a lot of uncertainty around that. So what are your thoughts? Do you expect more volatility? And as an investor, what are some ways that you can position yourself around that?
Yeah, so we definitely expect more volatility, right? Headed into the end of the year, we have supposed rate cut, earnings season, election, economic data that's still a little uncertain. So, we expect volatility to pick up, and, equity markets in the U.S., I think, still are the best place to be relative to other asset classes or investments. So how do you kind of manage that volatility in the face of all that uncertainty with the economic data? But again, still really constructive on equities, but with all those different pieces at play, we do think things are going to be volatile. Now, we just launched a suite of what are called calendar reset leverage ETFs. They have a longer reset on their performance versus the leverage ETFs that are out there now. So what it does is it helps smooth that volatility so that you don't have to be worrying about rebalancing your portfolio every day with kind of the current leverage ETF lineup that's out there now.
So would it be like regular ways, once a month that you're doing these resets, or what's the methodology like?
Yeah, so we have weekly resets and we have monthly resets currently. And so on sort of all the big ETFs, the big liquid ETFs that you know and love, just express a view. Again, they're all long right now, 2 times long. And we also have 2 single stock ETFs, NVIDIA and Tesla, of course, kind of the volatility darlings, if you will, that have reset their performance every week.
Right. So this isn't necessarily a longer term hedge, if you will. It's more of a directional bet or speculation that you would use these types of vehicles for?
Yeah, I wouldn't say, you're going to put them in your portfolio for years, right? But if you're still bullish on equities or those 2 stocks that I mentioned, at least for the next quarter or 2, perfectly fine to have in those types of
And investors are receptive to this type of leverage?
Yeah, we just launched them yesterday, and these are, it's a completely new structure. All the 200 leverage ETFs that are out there now, over the past 18 years have been built the same day with a daily performance reset. These are the first ones ever to actually have a weekly or monthly performance reset.
Yeah, which is interesting because, Phil, you have somewhat of a background in the ETF space. What's intriguing about that type of structure?
It gets a little bit nerdy and mathematical, but one of the problems is if the market goes up, you need to buy to re-lever your profits. So you're paying more to buy stocks when the market's up, and then when the market falls, you sell. So you don't really want to buy high and sell low over and over again, which is why when you have a volatile market, those daily resets actually tend to fall, regardless of whether you were right or wrong on the direction. So that's where the weekly and the monthly resets, it's going to expose you to less frequent trading, so you just let the momentum of the directionality run a bit longer.
I mean, that certainly has been the trade, right? Certainly the momentum trade. But Chris, sometimes volatility is good for a market. I mean, if you look at, well, to some extent, August 5th is an example, it was kind of an anomaly in a relative, what you'd expect to be somewhat, of a quiet trading day. But it was almost like a pressure valve was released. Everyone was looking for some sort of relief and valuation in one area of the market or the other. And it wasn't like it was a very disorderly thing.
Sell-offs are often very sharp, deep, and violent, and they come very quickly, sometimes without warning, or they have 1 or 2 catalysts. When you were talking about the employment numbers earlier, that was one of the major catalysts back in August. The sell-off we saw yesterday, so the economic data was a little bit soft, but it wasn't tremendously bad compared to some of the other items that we've seen, yet we still had one of the worst days that we've seen for the year, one of the 5 worst trading days downside across the board. So you never really want to, as a trader adage, and I've said this before, you never really want to short a dull market when it's moving up because it's baby steps on the way up. However, when you're selling off, it is a floodgate to the bottom because of all the programs that are trading. You have day traders that are involved and people who are nervous about protecting profits, especially in the retail with sell stop losses. The kind of volume begets volume and it continues to move down. We've still been looking for the correction period. We've hit it a little bit here and there, but it's nothing really sustained the entire year. It's been a very sharp move, not sharp move, but a dull move up and continues to move higher, even in the face of questionable economic data, to your point before, Matt. And the question then comes in, what is going to break this market? And at the moment, there's really nothing out there that seems to be the tipping point. When you have bad economic data, some people view it as good because you're finally going to start to get the labor market and the rate cuts that come along with it. And now that you've got inflation kind of under control, heading towards a 2% PCE level that they want, now you focus on the labor market. Can we survive this? And that's the wall of worry that we're requiring. So Maddie's product sounds very, very interesting, especially take that volatility out when you have those one-day blips. If you had a 1-month reset, you wouldn't have even seen that pop into the market at all, especially for NVIDIA, which is one of the key darlings right now. And actually, we had the NVIDIA All-Star Day last Wednesday on their earnings report. You would have taken that volatility out. So the sell-offs are violent, they're quick, and then they rebound because people are always looking for the 5 to 10% pullback in the equity to get back in, because there's no really, even though you have alternative investments, whether it's bonds, nominal rate of 4% guaranteed on the 2-year, you want to buy the larger cap names that are the darlings that continue to prove growth And when you have a pullback like you did, people snatch it up. And it took a while to get back up, but it did.
So Phil, if we were to get the 2 rate cuts this year, some people are even pricing in 3 to 4 rate cuts, I feel as if corporates have managed a higher interest rate, more capital intensive environment quite well for the most part in 2024.
It depends what corporates you're talking about.
Right.
So if you look at large cap, they obviously have had locked fixed rate debt pretty much across the board because the net interest expense has hardly changed. But if you look at mid caps, it's increasing a fair bit. And if you look at small caps, it's pretty close to all-time highs, interest expense as a percent of EBIT. So small cap companies have got more variable rate debt. They've had to reset more of their fixed rate debt at these higher rates. They're hurting much more. Their margins are being squeezed much more. That's why the large cap is really the space that's not exposed to the interest rates.
Well, I guess the question is, when you think about small caps, even if you do get the rate cuts, or you know, from I guess a fundamental perspective, are there reasons why that they are in the debt position that they're in, or are there, you know, there are other areas of the business that is, you know, creating the valuation that these stocks are trading at? I feel like that's kind of the question in the small cap.
Yeah, I mean, the returns do track. They've had an earnings recession, so the returns are down because the earnings are down. If you look at the forecast, it's meant to be a more broad-based recovery to earnings. So like as Chris says, a lot of the AI tech stack have had really strong margins, really strong growth. We saw that with NVIDIA. The small cap is expected to start to earn more, so it will have earnings gains. And I think the large cap is going to get a little bit more normalized. So it's hard to double your quarterly earnings every single quarter.
Right.
Eventually that's got to slow down. And if a more broad-based earnings recovery starts to happen and rates come down, you could see some rotation into small cap and not necessarily see the whole market sell off.
But Matt, that sounds like a healthy thing to me, right? So I mean, you're not, to Phil's point, you're not going to get double-digit returns every single year, and of course we have such short-term memory. That's all that we've experienced with a handful of stocks. But if it broadens out and it's, you know, more average than just one side to the chart or the other, sounds healthy.
Yeah, I mean, we started to see a little small cap breakout, right, this summer, and I don't know, it was a head fake. You know, it's sort of the debate, you know, is out there, but there's still not much dispersion, right? You have a lot of top-heavy, you know, index products out there, you know, and all the Goliath caps, I'll call them, are still dominating headlines, dominating investor attention. They're less sensitive to economic, you know, bad economic data, whether it be Mag 7 or however you want to classify it. So, you know, a broadening out is good. I'm just not sure that we're going to see it necessarily anytime soon.
Yeah. And it's like we're also seeing that, you know, in the primary and secondary markets as well. You know, when you think about IPOs, it's just there's a lot of questions out there.
You have to come to the capital markets, and if you want to raise if companies want to raise capital, coming to the capital markets where they want to go. The IPO market's better than it has been for the last couple of years, but because you've had such high interest rate, and to Phil's point, the cost of capital has just been unbelievably expensive. The promise of monetary policy loosening a little bit here is starting to see a little bit of spur. We're seeing more companies file for their S1s, indicating that they want to go public. That's a good sign. You're seeing a fair amount of M&A, especially on all across the board. Again, the capital market's at work. So the question then comes to, you know, quarter point, half point doesn't really make a difference realistically out of the gate. It's the messaging that comes along with it. And whether we're going to do 3 cuts, one cut at every meeting for the rest of the year and get us down 100 basis points or even 75 basis points, or we're going to continue to next year. By the end of next year, we should be probably at about 3%, give or take.
That's where the R-star apparently is. So that's a long way down from 5.5.
Long way down.
So until we get there, we're still contractionary from a monetary policy.
And if you're a cash burn company, we've talked about this before, you know, you're raising money in the short term, expecting that to come down. You know, and if you had you know, if 40% of the Russell 2000 is cash burn, right? So you need to raise that money for continuing investments in your company, whether it's research or what have you. You're going to have to pay that, and that comes with a significant haircut on the amount of money that you raise.
Right.
So that's going to eventually, potentially, add to earnings growth at the back end, which will make indexes like the Russell 2000 and other products that track smaller companies a little bit more attractive to investors, as opposed to a guaranteed 4% in your 2-year rate.
Think about it from a consumer perspective, right? Even if it comes down 100, 125 basis points over the next 6 to 9 months, right? What if you refinance? What if you have a variable rate and those come back down? That adds a lot of, you know, get 1% down, that adds a couple $100
and that's good for
your
GDP.
Discretionary spending every month, which could be good for your consumer stocks, which could be good for GDP. So I feel like those little fits and starts. You're looking at me skeptical.
Well,
does that make sense at all?
People are earning a lot of interest income now too, because they put trillions of dollars into money market funds.
Right.
So one of the reasons that income is beating inflation is because of the interest income, not necessarily because of the wages. So.
Correct.
Okay, but taking the other side of that, for people that perhaps
so
in a lower income bracket,
you look at the three different income brackets, right? So you're definitely catering to the high income bracket there, and some of the middle income bracket, but definitely not the lower income bracket. And the lower income bracket is doing without for the most part here.
Back to your consumer story.
Correct, right. So the question then comes in, what's going to make all of this work? You know, and you got to find that normalized rate. Yes, rates have been manufactured for a number of different reasons, whether at 0% for way too long, or maybe at 5.25 plus for way too long, right? So you got to find that normalized rate, and then may take 2 years before we get there. Hopefully we'll be back to where we were, well before all this happened. I don't know. We'll find out. But definitely, people are investing in the markets, and they're definitely putting money in the large cap names because that's where the growth is right now.
Yep, put them into ETFs that can ride out the volatility.
Yeah.
All right, appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.